Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Domino's Pizza Inc. Annual Report. Domino's Pizza offers a wide range of products and services to its customers worldwide. The company operates through three main segments: U.S. stores, international franchise, and supply chain. In terms of products, Domino's provides pizzas under the Domino's brand name, including specialty pizzas such as Parmesan stuffed crust pizza, spicy chicken bacon ranch pizza, garlic bread bites, and cinnamon bread bites. In addition to pizzas, Domino's also offers a variety of other menu items, including bread products, wings, boneless chicken, pastas, oven-baked sandwiches, soft drink products, and desserts. The company's diverse product offerings cater to different tastes and preferences, making it a popular choice for customers around the world. Domino's Pizza has been in operation since 1960 and is headquartered in Ann Arbor, Michigan. With its extensive range of products and services, Domino's continues to be a leading player in the pizza industry, providing convenience and quality food to its customers globally. The recent decline in Domino's Pizza Inc. stock price can be attributed to several key events that have unfolded over the past year. One significant factor was the company's third-quarter earnings report in October 2025, which saw a 15.59% drop in stock value. Although diluted earnings per share exceeded analyst estimates, total revenues narrowly missed expectations, and net income decreased by 5.2%. Furthermore, management warned of weakening consumer sentiment and a slowdown in sales momentum. Another contributing factor was the company's fourth-quarter 2024 earnings miss in February 2025, which saw a 6% drop in stock value. This was primarily driven by a surprising slowdown in same-store sales growth for its U.S. company-owned locations, with only a 0.5% increase in franchise-owned stores. The overall trend of U.S. consumers tightening their budgets also played a role, as evidenced by a 0.9% decline in U.S. retail sales in January 2025. These events collectively contributed to the -13.48% drop in Domino's Pizza Inc. stock price over the past year, highlighting challenges faced by the company in navigating changing consumer sentiment and market trends. Domino's Pizza Inc. market capitalization of $14 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Domino's Pizza Inc. holds a significant advantage in their industry. Domino's Pizza Inc. trades at a higher price-to-earnings ratio of 23 times, and a lower price-to-book ratio of -3.55 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 328% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline at Domino's Pizza can be attributed to several key factors. Firstly, the sales of food to franchise stores in the U.S. and Canada have been a significant contributor to revenue growth. Additionally, international franchise royalties and fees have also played a crucial role, with an average royalty rate of 3%. Furthermore, U.S. franchise advertising revenues have contributed to revenue growth, accounting for 6% of retail sales. Profit-sharing rebates and volume discounts to franchisees have also been a key driver of revenue growth. These incentives have encouraged franchisees to increase their sales, thereby contributing to the company's overall revenue. On the other hand, decline in revenue has been attributed to factors such as leaseback transactions and future minimum rent payments associated with new construction. However, these costs are expected to be offset by the benefits of increased revenue from growing sales and international expansion. The net income of the company experienced a significant increase between 2023 and 2025. In 2023, the net income was $519,118, which rose to $584,170 in 2024, representing an 8.5% growth. This upward trend continued into 2025, with the net income reaching $601,704. The profit margins also showed a positive change during this period. The net income margin increased from 11.6% in 2023 to 12.2% in 2025, indicating an improvement in profitability. Additionally, the consolidated gross margin as a percentage of revenues rose by 0.7 percentage points to 40% in 2025. However, there were some variations in profit margins across different segments. The U.S. company-owned store gross margin decreased by 2.4 percentage points in 2025, while the supply chain gross margin increased by 0.4 percentage points during the same period. Despite these fluctuations, the overall trend suggests that the company's profitability has been increasing over the past 3 years. The company's financial performance is a significant indicator of its overall health. One key metric that showcases the company's ability to generate sufficient funds from its operations is operating cash flow. According to various sections of the report, including page 43, page 45, and page 46, it is evident that the company is indeed generating positive operating cash flow. This is a crucial aspect of a company's financial performance, as it indicates that the business is able to cover its operational expenses without relying on external funding. Furthermore, this positive trend is also reflected in other sections of the report, such as page 57 and page 95, which provide additional confirmation of the company's ability to generate sufficient cash from its operations. The generation of positive operating cash flow suggests that the company has a strong foundation for growth and expansion. It implies that the business is able to manage its finances effectively, making it more likely to achieve long-term success. Overall, the company's ability to generate positive operating cash flow is a testament to its financial stability and resilience. The company's debt level has undergone significant fluctuations over the years. Initially, it increased from $425 million in 2018 to $1.85 billion in 2021, representing a substantial 340% rise. However, this trend was reversed as the debt decreased from $2.35 billion in 2024 to $1.85 billion in 2025. Furthermore, long-term debt also increased from $3,825,659 to $4,810,683 during the same period. Additionally, the company repaid $1.14 billion of senior notes and issued $1 billion in new notes in 2025. In terms of interest expenses, there have been some notable changes. The net interest expense decreased by 2.4% from 2024 to 2025, indicating a slight reduction in costs. However, the introduction of variable funding notes and new interest rates in 2025 led to significant changes in interest expenses. Overall, while there have been fluctuations in debt levels and interest expenses, some periods show no clear indication of significant change. The company's performance varied across different segments and regions in the fiscal year ended December 28, 2025. On a positive note, U.S. Stores and International Franchise segment showed significant growth with an increase of $24,956 and $27,883 in segment income respectively compared to the previous year. The delivery and carryout segments also performed well, capturing a market share of 32.9% and 19.6% respectively. In contrast, the supply chain segment experienced a decline of $40,541 in segment income. Furthermore, the international franchise segment faced challenges due to foreign currency exchange rate fluctuations, accounting for 6.9% of total revenues in 2025. The Canadian region was also affected by these fluctuations, as its revenues are denominated in Canadian dollars. Overall, while some segments and regions showed strong growth, others struggled with declining income and external factors such as foreign currency exchange rate fluctuations. Management is implementing the Hungry for More strategy to drive sales, store count, and profits. This four-pronged approach focuses on delivering the most delicious food, achieving operational excellence, providing renowned value, and leveraging best-in-class franchisees. The company aims to capitalize on its strong market position in the QSR pizza category, with a 23.3% total market share in the U.S. To achieve this goal, management is investing in technological innovation, e-commerce platforms, mobile apps, and integrated technology solutions, DOM-OS. They are also prioritizing product innovation and focusing on fortressing strategy to grow global store count. Furthermore, they plan to expand U.S. and international operations in existing and new markets through strategic partnerships with master franchisees. Management acknowledges the external risks facing the company, including health epidemics, labor shortages, inflation, economic downturns, supply chain disruptions, and cybersecurity incidents. However, they believe their brand and operational excellence will enable them to maintain a competitive position despite these challenges. In terms of financial management, the company is focused on managing debt, returning value to shareholders through share repurchases and dividends, and investing in growth initiatives such as consumer and store technology, supply chain centers, and corporate store operations. Overall, management's strategy appears to be centered around driving growth, improving operational efficiency, and enhancing shareholder value. The company has made several strategic moves through acquisitions and divestitures to optimize its operations and focus on core business activities. In terms of acquisitions, the company has been actively purchasing existing franchise stores, which allows it to expand its presence in the market while leveraging established brand recognition. Additionally, the company has also refranchised some of its existing company-owned stores, transferring ownership to franchisees while retaining a management role. This approach enables the company to free up resources and focus on high-growth areas. On the other hand, the company has made several divestitures to streamline its operations and reduce costs. One notable example is the refranchising of certain business units, which resulted in a gain of $4 million. The company has also transitioned its equipment and supplies business to a third-party supplier, allowing it to focus on core competencies. Furthermore, the sale of one supply chain center building and associated land for $14.9 million demonstrates the company's commitment to optimizing its real estate portfolio. Overall, these strategic moves reflect the company's efforts to adapt to changing market conditions and prioritize growth opportunities. By acquiring new stores and refranchising existing ones, the company is expanding its presence in the market while reducing costs through divestitures. The company has a history of distributing wealth to its shareholders through both dividends and share buybacks. In terms of dividend payments, the company has consistently paid out significant amounts over the past 3 years, with totals ranging from $169.8 million in 2023 to $236.9 million in 2025. In addition to paying dividends, the company has also been actively buying back shares on the market. Between 2025 and 2024, a total of 192.5 million shares were purchased, with a remaining balance of $459.7 million as of December 28, 2025. The total amount spent on share buybacks in 2025 was $354.7 million. Overall, the company's commitment to returning value to its shareholders is evident through both its dividend payments and share buyback activities. Concerns about inventory buildup or supply chain disruption are evident in the extracted summaries. On page 13, it is mentioned that a disruption in the supply chain could have an adverse effect on operating results. Similarly, on pages 15 and 16, potential shortages due to various reasons such as increased demand, capacity constraints, product recalls, and supplier difficulties are highlighted. Furthermore, page 17 notes that an increase in tariffs could disrupt and increase the costs of supply chains. This is a significant concern, as it can have a direct impact on business operations and profitability. Additionally, page 16 mentions potential disruptions affecting global food supply, which could negatively impact sales and profits. While there are some positive developments mentioned, such as increased supply chain revenue in 2025, page 38, these increases were partially offset by shifts in product mix and transition of equipment and supplies business to a third-party supplier. Overall, the concerns about inventory buildup or supply chain disruption seem to outweigh the positive developments, indicating potential risks for the business. That concludes the financial summary for Domino's Pizza Inc. Feel free to comment below, and I will be happy to answer them when possible.